Good afternoon, everyone. My name is Robert Rayburn here at Life Pro Asset Management. It is June 23rd, or sorry, pardon me, June 26th of 2023. And we're certainly glad that everyone could join us today. And I hope that everyone had a well-rested weekend. And, when we think of the month of June, we think of really a lot of sideways action, right? Underneath the surface, yes, we've had technology continue to power higher. Last week was not a good one for the markets. And when we think of our portfolios and how we're positioned away from technology and we're positioned really nailing the center there of the value component of the stock market, what we're at the end of the day focused on is the coming rotation that we see. So for clients in our portfolios, I think what you can expect when it relates to stocks in particular is a lot of sideways action, sometimes up, sometimes down, maybe a couple more down days and maybe a couple more up days. Doesn't matter. It's largely sideways trading in a channel until you get that technology bubble that pops. And once that thing pops, you're going to have a lot, in our opinion, you're going to have a lot of capital that's flowing out of that bubble into all the other areas of the market. And that's how we're positioned right now. So this week in particular, what I wanted to focus on was timing, right? So a bubble can go on for years, right? So we definitely don't want to be preparing for something that may happen in 2025 or 2026. And we know that's top of investors' minds as well, is like, when does this thing pop? So we're going to go through that, why we think we're very close in terms of weeks, not months or years. And so we're going to go through all of that today. But the three big things that I wanted to focus on, or that I want to focus on, are why do we care so much about the technology sector? If you're a client of ours, we have no exposure to technology. So that right there is one reason to care, because we don't have it. So when it runs, it makes us look kind of dumb, but we don't own it for a really, really specific reason. And number two, the state of that technology bubble. Talked a little bit about that a minute ago, but some of the cracks that have been showing up over the last, call it 5 to 7 trading days, are they real? Are they just a pullback before we get new highs? We're going to examine that today. And then lastly, the reasons why we like energy stocks so much. It's certainly our largest overweight in our equity portfolios. And we think this has years of runway, not weeks, not months. So when we think of technology, we think of days and weeks. We think of energy stocks, we're thinking months and years. So that's really, at the end of the day, how we look at risk and reward. Now, we showed this chart last week. What a bubble looks like. This is what a bubble looks like. When you have the top 5 stocks that represent 24% of the overall S&P 500, it's likely a bubble of some sort. When you have Apple, one company, a great company, by the way, but one company that's larger than Colgate, Kraft, Philip Morris, Costco, Pepsi, Target, Coca-Cola, Procter & Gamble, Altria, General Mills. And that's just the top 10 of the consumer staples sector. When it's larger than the entire consumer staples sector, which is composed of something like 100 companies, that's potentially a bubble, right? You can have a great company with a bad stock in the future. Microsoft was a great example of that in 2000. You can have a bad company with a great stock, right? A company that has gone through a lot of trials and tribulations and management turnover, but it's finally got its act together. The stock has sucked, but it's turning things around. Those are the types of stocks you would prefer to buy versus something that's already reached its zenith. And so that's something, when we look at this chart, we look at these market capitalizations of the largest mega cap tech companies out there. That's what gives us pause. That's what causes us to not sleep well at night, is what's happening there, because we know it's the core of many, many clients' portfolios out there. So we want to be very careful. And when we look at what's been driving that technology rally, so when we just look at technology in isolation, okay, so not technology relative to the rest of the market, but technology in isolation, this chart here on the left is the cap weight relative to the technology equal weight index. So in other words, when this line's going up, the largest tech stocks are outperforming the smallest ones. And when you think of a traditional bull market, it's that risk-on mentality, which in other words means stocks with higher beta or smaller cap stocks tend to outperform. Not this time around. What you've seen here is the largest companies, so the Apple, the Netflixes of the world, Amazon, Google, Tesla, those types of companies are outperforming. And so again, when we think of this bubble, it is exhibited at the top of the market, not at the bottom of the market, or not at the middle of the market, the very top. And that is where most people are exposed right now. And that's what's run year to date. The FANG stocks are somewhere up like 50%. And so they're about 30% of the index. We don't own any of them. So we've underperformed, and that's okay. We're fine with that, because when it pops, and we believe it will pop, we'll catch up pretty quick. So I'm not too concerned about that. Then when I look at the S&P 500 technology index and the earnings weight relative to the market cap weight, things are already starting to deteriorate. So the earnings weight of the technology sector within the S&P 500 peaked about a year and a half ago and has been falling ever since. But the market cap weight is close to its all-time high. So when you have this dislocation, usually what we see is that price resolves to the downside. And so we, again, underneath the surface, you're already seeing the cracks take place, whether that's through breadth and price action, or whether it's through that earnings weight relative to market cap weight of the overall technology sector. Then we look at NVIDIA. So let's look at a few charts. NVIDIA is the first chart we're going to examine here. So just an absolutely crazy move from, call it about 110 to 425 in the span of 3 months. Again, a bubble feels and looks and acts like a bubble. Okay, so at $425 a share and something like 140 times earnings, and 25 times 2025 sales, which is insane. It looks like a bubble. But from a short-term trading action, bubbles can go for a longer period of time. But what we have noticed more recently is the RSI, the Relative Strength Index, has reached massively overbought conditions, right? The last time we were in this overbought condition was back in November and December of 2021, when you had that other big peak within NVIDIA and other technology shares as well. So you see that big overbought condition here, another very large overbought condition. Pair that up with some anecdotal, qualitative aspects that are taking place in the market right now, such as the number of times that artificial intelligence is mentioned in the news media, just absolutely skyrocketing here, as you can see here, the chart on the left. Something very similar happened with the dot-coms in 2000. If you watch our update from last week, you'll see the chart almost looks identical. So we want to be mindful of these sort of crowd-like instincts that take place near tops and bottoms of the market. Apple, very similar. Apologize, the circles are a little bit off here, but again, the RSI, very extreme here. The RSI, very extreme here as well. This was a midterm peak. We think we're again approaching a midterm peak, or maybe a secular peak in the price of Apple. So again, Apple is the largest company on the planet, the largest company within the infotech sector. We want to be extremely careful here. It's a great company. We're not knocking the company. We're knocking the stock. We're knocking the crowds that are chasing the stock because they don't want to own anything else in the market. We actually think all the other stuff in the market is a lot more valuable here at these price levels than Apple is. So that is our concern. And what could be another trigger aside from trading conditions? Well, certainly what's happening in the bond market. So when we look at what's happening in the bond market, real yields in the US continue to creep upward. So the US right now is one of the only countries aside from Canada that has a positive real yield. In other words, the yield of the bonds minus the inflation rate gives you a positive rate of return. When that type of stuff happens, you tend to get multiple compression in the valuations of stocks, especially high growth stocks. Why? Because stocks have competition. You can buy a bond and get positive real returns relative to the rate of inflation. So it takes money away from the stock market. So that's something we want to be careful of. So we see here on the chart on the right is that the NASDAQ price to earnings multiple with the inverted real yield of the 10-year treasury. So in other words, when this blue line comes down, it means real yield is actually going up. We just inverted the scale. And what you can see here is that you've had massive multiple expansion for the NASDAQ. And how do we know that? Because earnings have actually gone down. And when we look at projected earnings, they're largely flattened down as well. But you've had the stocks rip almost back to prior highs. So that's what we call aggressive multiple expansion at a time when real yields are rising. And historically, real yields compress valuation multiples. We're going to stick to this because this is, we look throughout history, this has been a very good guide. And we're not going to, again, we're not going to pick up pennies in front of a train or in front of a bulldozer or whatever that analogy is you want to use. So why is technology so important to us? Again, I said this before, we don't own it. So when the market's running powered by tech, we want to pay attention. Hey, are we wrong about something? But every day that it happens, we look and we get more conviction that, hey, this is, at the end of the day, this is what's going to define 2023, 2024, is this bubble that pops and all of this money, right? This 34% of the S&P 500 that has to find a home. And we think it's going to find a home in some of the cheapest sectors with some of the, what we consider some of the best fundamentals out there, such as energy, materials, metals and mining. Energy actually, after the recent sell-off, is under 5% of the S&P 500. Materials, 2.76%. Metals and mining, such as the golds, only 0.45% of the S&P 500. So it's not going to take a whole lot of price or cash outflow from this big bubble to dramatically impact the prices of these smaller sectors. That's why we're so excited by it. That's why we're not trading. That's why we're accumulating the same sectors every time you get a pullback. We are incredibly excited by what's taking place in the old economy. So wanted to remind people of that generational shift that we believe is taking place in the market out of tech and into energy, materials, and industrials. We believe these stocks are cheap, the earnings are improving, they're under-owned, they're maligned, they're hated. No one wants to talk about them. Oh, they're not AI. Why do I want to own a steel company? Well, their earnings are really freaking good. That's why. So they generate a lot of cash flow. That's why they're paying dividends to shareholders, and they're increasing them every single quarter or every single year, pardon me. That's why. And the valuations are incredibly attractive. Go back to, and we're going to just pound away at this chart, which is the commodities to equity ratio. I think it's the most important chart of the decade. I might talk about this verbatim for ad nauseum, pardon me, for the next year or 2 years, and people are going to get sick and tired of it. But I think it's the most important chart. And I think it's going to go back at least to the mean over a long period of time. So this is where the opportunity is, commodity stocks versus everything else. We believe it's as important as the relative turn for tech stocks in 2009. And why do we like energy so much specifically? They're cheap relative to the earnings growth offered. Many of these companies are growing double digits in terms of their earnings and free cash flow growth, while the multiples are in the single digits. The S&P 500 is trading 18, 19 times earnings. Energy sector is around 8 to 9 times earnings. Strict stewardship of capital. They're not plowing money back into the ground and blowing their brains out in terms of production and bringing on all these wells that are uneconomic. No, they're just growing their free cash flow and they're passing that cash to shareholders. And as a result of that, you're not getting this huge production growth in the US. So you're seeing global supply constraints across the world for oil. It doesn't take much of a demand spark to really create a massive shortage in the energy space. And we think there's going to be a massive shortage. CapEx growth remains low relative to history. We kind of alluded to that a little bit just a second ago. But again, the amount of capital expenditures going into the ground is at near record lows. There's been no capital investment in the ground over the last decade. So as demand's recovering from China, India, US, and Europe all at the same time, it's going to take years to develop these new sources of energy. And so you can't just respond to new supply by bringing on all these wells. So that there's a response time lag there that's going to create, we think, a huge tailwind for the shares of energy stocks. Significant free cash flow generation. If you're talking about Occidental with 20% plus free cash flow yields, just incredible numbers that you don't see anywhere else in the market right now. And of course, as we mentioned in the prior chart, commodities we believe are a secular low relative to stocks, the rest of the stock market, pardon me. And if you look at energy, the earnings weight of 12.7% of the S&P 500 relative to its sector weight of only 4.6%. Every other sector is relatively in line with its earnings weight, except for two sectors, energy and technology, which its earnings weight is at 19, but its sector weight's at 26. We think this is going to flip, and we want to be prepared for it today. So bottom line is, we believe that every day that the bubble in technology expands, it's becoming more and more dangerous. So we're focused on opportunities elsewhere, and investing is about the long term, and investing is about, getting ahead of the crowd. And we're going to stick to that. I think in 2021, we didn't let some of those trades play out long enough, but this is where we want to let them play. This is where we want to let the leash loose a little bit. So if you own technology, we would definitely consider at a minimum selling some. It's important. We think that it's a very dangerous bubble. As that technology bubble does pop, we think that money rotates into other areas of the market. In particular, we think commodities are the place to be. Commodities relative to equities at that secular low. So that's what we got for you today. Hope that everyone's having a great weekend or has a great week. And if you have any questions, please feel free to reach out to your advisor, or you can contact us at the home office at 888-543-3776. Thank you again, and have a great week.